Candlestick patterns. Candlestick patterns are patterns on the chart that give you signs and signals that the market about to go up or down. What you have to do is do your proper analysis and pick high quality trades. And candlesticks are separated in two parts. We have a bullish pattern and a bearish pattern. The bullish stands for the bulls, the market is going up. Bearish stands for the bears, when the market is going down. Pattern works best at key levels. For example, a railway pattern at a support or resistance level on a higher time frame, like a 1 hour time frame, it's probably going to play out nicely. Now in this example, we're using the double top. Key levels, see this white dotted line? That is resistance. How I know? Because the market came up and rejected in the past. So when it come up to this level, I expect it to reject it again. And this time I got confirmation because I got rejection at this key level and I got a double top. That's a powerful setup. And what the market do, it came back and retest and then it dropped. Remember, you want to see candlestick patterns happening at key levels like a support or resistance or supply and demand level. Support and resistance, this is the foundation of trading. Think of resistance as the ceiling. Think of support as the floor. If you jump up and hit your head on the ceiling, what's going to happen? You're going to come back down. If you bounce a basketball on the floor, what's going to happen? It's going to come up. So this is support and resistance. And a lot of people like to trade support and resistance. How? When the market comes to support, they'll buy because they expect the market to go up. When the market comes to resistance, they'll sell because they expect the market to come down. This is support and resistance. Once you know this, everything else can come into play. Support and resistance can also form diagonally. As you see, it bounce off resistance. It come down to support. It bounce off resistance, support, resistance, and it's on an uptrend. You see that, right? So, because it bounced off support and resistance, you're probably asking, do it ever break through support or resistance? Yes. In this chart, for example, it bounced off support, it bounced off resistance, it come down to support, and then it break through resistance. And look what happened. Resistance becomes support, okay? And you have a new resistance up above. Vice versa for support. If it breaks support, support becomes resistance. So these levels can be broken. The more touches, the stronger the level are. Like 3 touches right here. 1, 2, 3. This is a strong support level. Now, market structure. How do we know if the market is going on an uptrend or a downtrend? It creates higher highs and higher lows on the uptrend. It creates lower lows and lower highs on the downtrend. You have previous high, previous low. You have new structure high and new structure low. So let's talk about it. So the market going up, it created new structure high. Then it created a higher low. Then it created a higher high because this high is higher than the previous high right here. Then it created a higher low because this low is higher than the previous low. It's on an uptrend. It created a higher high. But look what happened. It broke down. It's coming down. It created a new structure low. How I know? Because it broke this low. This low was holding support right here. This was the support level. It broke through support. It came back up and retested support. And what it did, created a lower high. Because this high is lower than that high. Now it's creating a lower low, lower high, lower low. And it retests previous high. And it retests previous low. So this is how the market goes on an uptrend. These are signs of a reversal, and it's going on a downtrend now. Higher highs and higher lows create an uptrend. Lower highs and lower lows create a downtrend. Now let's talk about some of my favorite patterns. Also some of the most popular patterns when it comes to day trading. Trading period. Right here you have a left shoulder. You have a head. You have a right shoulder. This is a head and shoulder pattern. This is the neckline. It broke the neckline. Now we expect it to go on a downtrend. You have an uptrend up here. Once it breaks the neckline, you have a downtrend. This is what you want to trade, the downtrend. A head and shoulder pattern. This is an inverted head and shoulder pattern. It's just in the opposite direction. You have your shoulder, you have your head, you have your shoulder. Breaks the neckline and goes on an uptrend. This is a double bottom. You got your bottom. You got your second leg to the bottom. It looks like a W. Okay? It breaks the neckline, goes on an uptrend. But most traders get messed up at, they think they're missing out on the trade, so they hop in way up here. What you want to do is wait for the retest. When the market come down, you hop in. Then you set your stop loss below this neck, these two candles right here. You dig? This is called a retracement. Every time the market break a key level, wait for the retracement. Don't fear of missing out on this trade because you'll hop in and then it's coming back and you're in the negative, you're in a drawdown. You got to be patient. Wait for it to come back and test this neckline because this neckline is resistance. Now it's turning support because the market above it. So when they come back to support, they start forming this green candle to show you that the market is about to go up. That's when you want to get in this trade. And the retest and the pullback happen in every pattern. Always be patient. This is a double top, okay? Same thing, just in the opposite direction. You got your first leg, you got your second leg, and it's shaped like an M, okay? They break the neckline. Some of y'all feel missing out in the trade. Y'all get in right here. The market come back, hit your stop loss, and all you had to do is wait for the retest or wait for the pullback to this level. Because when they get to support, what do? It turn red. It's a signal that the market is going down. Flags and pennants. This is a bull flag, one of my favorite patterns. The market going up, consolidate, create a flag, and then they break out and go ahead to the top. I don't just hop in on this breakout. I wait for the pullback or the retest back to support, then I get in this trade and ride it up. This is a bear flag. The market going down. Consolidate, create the flag, then they break out, go on the downtrend. This is pennant. This is a pennant. The difference between the pennant and the flag, the pennant have the triangle, you dig? The market go up, create the triangle, get smaller and smaller, then they break out and go up. A bearish pennant. The market come down, consolidate for a minute, get smaller and smaller, and leave room to breathe, and break out to the bottom, and it goes. Now, can these candlestick patterns fail sometimes? They do fail. As a trader, you will learn everything is not perfect. It's all about high quality trades and probabilities. But as long as you manage your money, the odds are in your favor. This is a bearish railway track. They're like two train tracks. The market going up, it hit resistance on this bearish candle to show us a signal that the market is going down. This is a bullish railway track. The market is coming down. Then they bounce off support and form a green candle. That's a signal that the market is going up. Okay? Remember, it's happening at support and resistance, key levels. You have a bearish pin bar and a bullish pin bar. These pin bars alone are powerful. They're some of the strongest patterns on the chart. When you see these pin bars, take a look at it, pay attention. Okay? Because what's happening is the market is going up, and it was up this high, but it got exhausted. The sellers pushed this candlestick down and formed a small body. So basically, the buyers got exhausted, now the sellers are taking over. These are signs. Candlestick tells stories. Pay attention to the story. What happened on the next candle? You have a bearish candlestick for a downtrend. Now a bullish pin bar. You have a bullish pin bar. See, the market was way down here. Sellers got exhausted. The buyers pushed it back up and closed. Closed up here, you dig? And then the next candle form was bullish for an uptrend. These pin bars are powerful. You have engulfing candlestick patterns. These are powerful candlestick patterns too. You have your engulfing candle. You have your bearish candle. This candle can fit inside this candle. This candle engulfing this candle. It's happening at support. You see that? The market's probably going to go up. Right here is a bearish candle, a bearish engulfing candle. You can put this candle inside of that candle, and it's happening at a key level, which is resistance. So it's a sign that the market is going down. There are many candlestick patterns. These are the popular ones that most traders know about and most traders trade, but you can go on Google or anything and Google any candlestick pattern get familiar with them, because there are all kinds of candlestick patterns on these charts. I just limit myself to a few candlestick patterns, and I master these candlestick patterns. But remember, candlestick patterns have to happen at key levels. You want to take high quality trades and you want to manage your money. Y'all gonna hear me repeat this over and over. This your boy Leo. See y'all in the next video.